right. Thanks of you that voted.
I think.
All right, so then just a quick recap. Thanks everyone for joining. I am going to record this webinar and I'll provide a PDF of this after, so no worries on taking notes. We have a ton of content to get through, so let's get at it. So your speakers tonight, it'll be me, Sabrina Guler, Charlie Rushton, and Kyle joining. A little bit about my background. I was introduced to real estate in 2014 when I became a licensed real estate agent back in the New York City metro market. I took a little bit of a hiatus and focused on my full-time career, which has been engineering project management for the last 6 years. During that time frame, I have invested myself, heavily focusing on the Arizona market. And I was introduced to Charlie and Kyle throughout my investing journey, primarily focusing on commercial real estate. That's a little bit about my background. I know most of you on this call have met me through working at Apple. Thanks for joining. And yeah, I'll hand it off to Charlie.
Good evening, everyone. Thanks for joining us. My background is predominantly in hospitality, and I started investing in real estate around 2007 in the single family arena. Graduated into multifamily about 2.5 years ago, and have been building a small portfolio with team members. Kyle was my first partner in our 16 unit that we have, and I used to syndicate oil and gas, which brought me into the syndication world of multifamily as well, and that's where we aim to stay. So welcome and thanks for joining us again tonight.
Hey guys, my name's Kyle. I'm up in the Seattle area, but used to live in Arizona and down there pretty often. So look forward to jumping in here. I'm a investment advisor. I've been doing that for about 12 or 13 years. So I love investing, but over the last few years have been excited to get into real estate investing, and especially on the commercial side. So that's where my focus has been as of recent, and yeah, excited to be part of the team here.
All right, let's get started in the Phoenix market. So a couple of reasons why we love Phoenix. First of all, it's a growing population and labor pool. It's very business friendly. It's growing and diversifying its employment market. It has a modernized infrastructure. And my favorite is the affordability and the quality of life. A couple of fun facts about Phoenix. The average annual temperature is 75 degrees. Over the summer, it does get a little toasty, as it is right now. But for 8 months out of the year, it's pretty damn good. There are 300 days of sunshine out here, which you can't beat. And if you live in California pre-COVID, you know what traffic is like. And here, it's about 26 minutes of average commute, which there is like your trip to the grocery store. Right here on the map on your right-hand side, just goes to show how central Phoenix is. The way that we built our highways and our rail systems and how accessible we are just makes it just an incredible way to travel. You're about 6 hours from LA, 5 hours from San Diego by car, about 5 hours from Las Vegas by car. So we're just very centralized. I just wanted to quickly flash this up and just show Phoenix's population growth versus the national average. We have been the fastest growing metro, one of, for the last couple of years, comparable to Dallas, Houston, Austin, Atlanta, Orlando, Seattle, some inland areas of California, other parts of Florida, and DC. On this slide, I'll probably just focus a lot on inbound migration. There are a lot of people relocating from many different parts of the country here in Phoenix. Here are just the major areas of people coming from, one of the largest being Los Angeles and other parts of California. I'll include myself in that statistic, as well as a lot of Midwest cities, colder areas of the country, such as New York, Chicago, Michigan. And we're a huge snowbird state, meaning that a lot of people do come here and live here 6 months out of the year. A lot of people come from Canada and colder climates.
Mhm.
And then just to touch base, population by age, we're pretty diverse here as well.
Yeah, I think that's one of the things people notice as we go through is the age demographics here. Definitely a younger population. People really like moving in here. We'll talk about the quality of life, but definitely something that you'll notice about looking at the cities and the type of people who are moving to Phoenix right now.
And it used to be, Arizona kind of used to be looked at as like a retirement community. And as we had a lot of new company acquisitions and the universities here kind of identified themselves as innovative and more technology focused, we've had a lot of younger crowds come here to develop their careers and start families. So it's changed over the last 10 years for sure, but we're definitely diversified in terms of age. Kyle, you want to maybe talk
Yeah,
through?
this one's interesting. So you asked the question, why are people coming here? And we've kind of touched on the quality of life. I mean, there's so many things to do around the area, outdoors activities, year-round sunshine, professional sports teams, spring training. I mean, you can go on, the list goes on for a long time. So a lot of attractive amenities and activities here. But money talks too. And if you look at the cost of living, you can see that Phoenix right now, this isn't every city in the country, but you can see they rank at the top or near the top in most of these rankings. So, Phoenix at a 99.4 in terms of cost of living. And so for a lot of people, that's pretty attractive. So if you're someone living in Seattle or San Francisco, and especially if you have the ability to, work remote somewhere, having your money go twice as far and coming to Phoenix and not really having to sacrifice much other than, there's no ocean in Arizona, but so no beaches, but you can still get a pretty high quality of life. And if you can work remote and kind of make your same salary, it's pretty attractive. So that's one of the trends that we're definitely seeing. And then in terms of the economy, you can see very balanced. We have lots of different sectors. And you look at things like healthcare, extremely stable. We're always going to have a demand for healthcare, but especially one of the things that we'll be focusing on is just kind of the increased growth, information technology, tech. Lots of companies moving in. So that's one of the things we look for in a market is just a very balanced market. People use the term recession resistant, and this is really what we're talking about. It's not overly concentrated. You hear some cities might be too heavily concentrated in things like oil or energy or maybe hospitality and tourism. But Phoenix is, because of the diversification, at some point we'll have a downturn, but we're very comfortable with being able to kind of weather that storm just based on the strong economy. So.
We're about to add another hub here in terms of key industries, and that's the electric car industry as well. Arizona has acquired 3 new companies this year that we're really excited about.
Mm-hmm. Yeah, so in terms of employers, you can see some of these major employers, lots of Fortune 500 companies. Many of those are actually headquartered in Arizona, names you recognize. Other companies, like Amazon, Target, Walmart, they may not be headquartered here, but they have major operation or logistics centers here. Arizona is also known for their financial services. You have, some large banks, again, either headquartered here or with large operations. So again, it really just speaks to the diversification. You've got all these different sectors and just well-known, established companies, as well as a lot of, growing, successful companies there as well. So again, talking about why people come here, if you're employed by one of these companies or if you're looking for new employment, there's lots of opportunity here.
Yeah, and I think this list doesn't include all of the newer companies that have just signed deals with Governor Ducey here. We have a whole slide that covers some pretty groundbreaking acquisitions that will provide, a mass bump in GDP and, overall wages for Arizona. Mm-hmm. So this is currently what's just here now.
Yeah, so kind of similar to the question of why are people moving here? Well, why are businesses moving here? And again, it really comes down to one of the primary reasons is money. So if you look at cost of doing business, this scale down here at the bottom right, kind of shows the range of least expensive to most expensive. And you look at cities like San Francisco, San Jose. I know a lot of people here are familiar with those. So if you're a business owner and you're paying, 85 bucks a square foot for your office in San Francisco, and you're starting to think maybe I could find that, cut my costs by a third and move to, Phoenix. It's a pretty telling story. And then same things with labor costs. You can see some average costs there to hire, an average software engineer, as well as corporate tax rates are pretty low in Arizona compared to some of the other states here. One thing too, Arizona, both at a state and local level, they're offering a lot of tax incentives. They're being really aggressive, trying to find companies to move down here. So that's another pretty attractive reason for a lot of companies to come here. It's just kind of the business-friendly environment, low taxes and incentives. And if there's some other very strong cities on here that we're looking at, Salt Lake City, Dallas, that also have low cost of living as well. But Phoenix is, again, right there at the top of the chart. And then as Sabrina mentioned, a lot of, you can see a number of companies on the Fast 500 list, startup companies and growth companies, other companies in Phoenix that you'll recognize, companies like Freshly and Lyft and Retail Me Not. So a very growing tech hub here. Also, one of the things we'll talk about is there's just a lot of talent here in the area, both with people moving in as well as some of the universities and programs, a lot of different innovation centers. So it's just a very attractive place, if you're a tech company or startup company. And then this one's interesting because it just kind of shows, again, another trend. But if you look at co-working spaces, if you're a company like WeWork or Industrious, you're doing your research, you want to be where the talent is, where people are going, where these companies are popping up. And so you'll kind of notice this concentration around Tempe, which has really become a huge hotspot. Chandler, Gilbert, some of these areas down there in the southeast, Scottsdale. And so again, it's just kind of following the trends, seeing where companies like this are wanting to be, and that's also where we're trying to look when we're looking for opportunities.
So you want me to take this one, Kyle?
Sure. Mm-hmm.
So this shows like some of the most popular submarkets here in the Phoenix metro area. And we'll go through some of these in depth, but in terms of multifamily rent growth and what that's looked like since 2015, we've just had some incredible exponential growth. Let's start with downtown Phoenix up in our upper left-hand corner. If you owned multifamily and you owned in downtown Phoenix, you've seen a 23% rent growth since April of 2015. If you've owned in Chandler is a submarket right now. Intel has their one of their largest headquarters there. They have PayPal there. It's a corporate hub in Chandler. If you owned multifamily in Chandler, you've seen 37% rent growth since 2015. In Tempe, on your right lower hand side, that's where Arizona State University is, as well as some of what Kyle mentioned, major banks and other huge tech towers and bank headquarters. There, if you owned multifamily, you've seen 30% rent growth, and then same for Scottsdale at 36%. And then on your bottom left-hand corner, that's just the Phoenix Metro, which represents all of these submarkets. And added up since 2015, you've seen a total of 42%, which is pretty unheard of unless you're in Austin or some of these other super bullish markets.
I mean, it even exceeds Dallas as well at this point.
So this is a map that I created based on some of the major companies coming into town or huge development projects that are happening as we speak. On your left bottom hand corner, there's a zoomed in map of the red highlighted area. That is a piece of land that was bought by D.R. Horton. They're a pretty well-known single family builder based out in Texas, and they outbid Shea Homes. Shea is a pretty common single family builder. They overbid them for $245 million worth of land acquisition, where they plan on building 3 new cities that are the size of Mesa, Gilbert, and Tempe, shown in on the bottom hand corner. that don't exist yet. So not only do we have markets that are just growing and booming as is, but we are building to create other cities because we actually underbuilt. Phoenix in 2005 was one of those cities that was booming. And then because of the recession, a lot of development had stopped. And then, now with COVID, we've pretty much accelerated our growth that we were supposed to be doing probably within a 10-year window, but we crammed that all within like a 2-year span. So we're very undeveloped here. We need a ton of housing, which is great if you're an investor. One, because your house won't stay, or your condo won't stay on the market for very long before it gets rented. I personally own investment property here. And, the first time I launched my Airbnb, I was completely booked at like 99% occupancy 48 hours after I launched my Airbnb. And that was during COVID. So there's a high rental demand here. I think there are 250 people that move to Phoenix every single day. So that's why they need to build more cities, more schools to balance out the supply and demand here. So that's on your left-hand corner. A couple other projects that I want to call out. There's TSMC. They just signed up to put a huge manufacturing hub here in Phoenix. It was an $11 billion acquisition, and they just signed they just closed escrow, on their land in North Phoenix. You also have City North. It's supposed to be an amazing new development where young professionals are supposed to live. It's supposed to be a mini tech hub up north. So that's coming into town. It should be done within the next 2 years. And then also another thing that I've been keeping my eye out on that I love is Arizona has been, for some reason, an electric car hub where you have some of Tesla's top competitors coming here. So you have Lucid Motors over in Casa Grande, you have Nikola over in Florence, and then you have Electromagnetica in Mesa. So some really exciting stuff coming to the Phoenix metro area.
And it's interesting too, the expansion is not just happening in one area or one direction. I mean, it's really going, east, west, north, which is, each area offers something different. But yeah, I mean, it's just really kind of fun to see the growth and happening here.
Yeah, and it's funny when people ask me, well, where should I invest? And I'm like, well, I don't know where to start because we're just bursting at the seams here with growth. I mean, everywhere you look, there's new development going up. So really exciting. So this is just a quick snapshot of ASU. I don't know if there are any ASU grads on the call, but I'm an ASU grad. ASU has been called out to be one of the top innovative universities in the country. We've expanded our business programs. I think we're, if not number one, maybe number two top online program. I actually did their online program and I thought it was great. And we're top 10 university for research and also for undergraduate education. So, I think another reason why companies come out here is because they realize a lot of the student talent and they're willing to position their headquarters out here, assuming that they can hire a lot of post-grads.
Yeah, even besides ASU, you have obviously U of A, you have Grand Canyon, you have a number of other local universities. Then the big one that people forget about, University of Phoenix, which is obviously national, but still based here. So yeah, ton of talent that's staying home, and companies love the ability to go recruit these people to work for them.
And also sports too. Like the sports teams that come out of these universities have been, pretty top tier as well.
Mm-hmm.
So just a couple of quick stats on housing. So this is most recent 2021 data pulled for single family. Right now, the median home price for resale, so an older home, is about $342,000, and a newer home, newer construction, is around $361,000. These are averages, and there are still a lot of parts in the Phoenix metro area that swing. It's a very wide spectrum of pricing. But I'd confidently say that if you sold your home in the last year, you have made 20% on your home. And I've seen that growth on both of my properties here that I own. So I can attest to that. And then if you've owned, if you bought new construction in the last year, you've made around 6% on average. And then just to call out multifamily, the average rent right now is about $1,200 a month. And again, the spectrum here swings, and we'll cover rents in depth in about a second in another slide. The average vacancy here is 4%, which is pretty killer.
It's almost unheard of.
So average rents here in the Phoenix metro area. So about a studio's a little over $900 on average. One bedroom's a little over 1,000. Two bedrooms around that 1,200-1,300 range. Three bedrooms in that 1,700-1,800 range, and then four bedrooms around 2,000. On average, for the Phoenix metro area, which is pretty large, we've seen around a 7 to 8% growth year over year, which again is awesome. And here is where I wanted to kind of dive deep and talk about all these little submarkets. Each color is associated with its place on the map. But if you've noticed, the Southwest Maricopa County, which is pretty large, as well as the that whole green belt on the map, if you've invested there over the last year, you've seen anything, between 10 to almost 15% growth on your rents, which is pretty wild. And your occupancy is higher than 95%.
One of the other things that's interesting too, if you go back to the previous slide there, you'll notice on the right-hand side, we've got two different types of asset classes. We have renters by necessity, which is, think of like your workforce housing that, they'd probably love to be able to afford a single or live in a single family home, but they just can't afford it right now. So they're, renting by necessity. And that's been, growing steadily, but not as rapidly as the lifestyle, which is people that are choosing to rent, typically these maybe a little bit more upscale type apartments, but they're wanting the lifestyle. They want to be close to everything, close to the city, entertainment, that type of thing. They like the amenities. So to see that growth over the last couple of years is something that we're definitely paying close attention to. And that's also the type of asset or investment that is attracting a lot of these people, especially tech workers coming into the city. So definitely something to keep an eye on there as well.
And then another thing to note is I've seen a lot of interest from investors on the topic of Airbnb and corporate rentals and just short-term rentals in general. Since Arizona is a snowbird market and a lot of people come from colder climate cities and states, it's a very friendly short-term rental market, and you are able to charge quite a bit higher on the rents that we show here for rentals, like a short-term rental. So I just like to call that out. Anything else here, Kyle?
Yeah, I think just kind of pointing out the just kind of the massive numbers there. I mean, 15% year-over-year rent growth is really unheard of. I mean, you can look all over the country, and it's extremely hard to find that. So the fact that we have several submarkets in the double digits in terms of rent growth, yeah, it's pretty astounding here.
So just a couple of other growth markets that we're focusing on in Arizona. Tucson is one of them, which we'll cover in our part 2 tonight. Sierra Vista is south of Tucson. It's known to be a very large military base, and it's super tourist friendly. We actually just acquired a property there recently that we just closed on. And then Casa Grande, which I mentioned. Casa Grande is like the midpoint between Phoenix and Tucson. And if you're a local and you're from Arizona, it's always been like a dream or a discussion that at some point both markets might actually, touch in the middle and kind of grow into one giant market. So Casa Grande has seen, a large population boom, and yeah, we're also very, very focused on Casa Grande as well.
Yeah, one of the plays there that we're looking at is new development, just because it's such a new kind of boom town that, to kind of get in now, there's some pretty big opportunity there on the development side that we're looking at as well.
So our part 2 is Tucson. What is Tucson known for? So a couple of call outs from the employment side, industries that stand out. Tucson is primarily known for aerospace engineering. We have huge missile and defense companies out there, a lot of military bases. Raytheon Missile Systems is one of Tucson's largest employers. So that's out there, as well as renewable energy. The medical industry is huge there. If you're interested in becoming a doctor, the programs at U of A are pretty incredible. There's a lot of cancer research based out in Tucson as well, Banner Hospital. And then also we have a lot of customer service and manufacturing as well. Like I believe Amazon's one of their customer service and manufacturing production centers is in Tucson. Median household income is around 53,000. So it's slightly lower than Phoenix, and the overall population is also lower as well. It's around 1.4 million. And then a small shout out, we just had a global medical tech company. They just acquired a piece of land in Tucson, and their plan is to build a $65 million state-of-the-art facility in Tucson, which is supposed to provide a number of jobs that will boost the economy out there as well. So just looking at the multifamily market, vacancy is pretty similar to Phoenix. You're about a 4% since last year. And then year over year change is still very strong. Tucson is about a 9%. And Tucson is pretty large. There's a lot of submarkets, which we'll get into. But I mean, 9% year over year is just incredible. Average price per unit, if you were to buy a multifamily, is $85,000 per unit. This changes wildly per asset class. I'd say Class C, you're looking around 75. Class B, you're hitting around that 90 range, and then Class A, which is really booming in Tucson. There's a lot of new development that will be considered Class A. You're in the 100, 120s, 130s. So that's kind of what swings and makes that average an 85. And then the average cap rate, again, it depends on the asset class, but we're looking at a 5.6, and then it swings a little bit into the lower 6 range. And this is just charts to kind of reinforce what I just mentioned. 4% vacancy, and then cap rates around 6. And then this is just a chart that shows like annual change in rent growth and kind of where we've gone from 2016 all the way up to 2021. Similarly to Phoenix, we kind of break down the submarket areas, and we talk through what the year over year looks like per submarket. So I think the overall here is very positive. And if you look down at the bottom where it says university, I think we all know what happened last year with COVID. A lot of people were living at home with their parents, so it explains the dip there. But yeah, overall rents here have been exponentially growing. I personally own in the Catalina foothills, and I think this past year I saw about a 9% growth for my rental property.
Yeah, it's important to keep in mind too that 9% growth rate, that includes the university district, which really skewed those numbers to a degree. So if this would have been a normal couple of years, we likely would have seen double-digit growth in Tucson on average. But yeah, pretty similar to Phoenix. You just have some really strong performing submarkets in the double digits, and again, those are the ones that we're really looking closely at.
So I think just kind of to cap where we're at, I mean, reasons why we love the Phoenix and surrounding areas, I think overall it's cost of living, tax and business friendly opportunities, quality of life, you really can't beat. I mean, the universities bring a ton of talent and they bring new job growth, which brings me to how we are increasingly becoming a booming tech hub, and we're very attractive for new startups. And just a diversified and robust economy like Kyle walked us through. Obviously, the year over year rent growth is really attractive. But like Kyle mentioned, when we look at these recession-friendly markets, we kind of look for a balance across a bunch of different metrics and values within a city. And we just think Arizona is here to stay in terms of growth.
Mhm.
All right, Charlie, you want to walk us through our
Sure.
position?
So as Sabrina had mentioned, we've just acquired, and on Tuesday we signed and closed on a 100-unit hotel conversion. You've probably heard about these kind of strategies, certainly more so from the pandemic, and they're becoming a lot more popular. The idea being is that we take over a hotel, a motel, lower end hotel, and convert it into multifamily units. This one in particular was 100 doors that we're converting to 65 units. We chose the Sierra Vista area. One of our strategies is that we partner with other general partners to find and execute on these deals. We're always looking in these different markets. We don't always find the deals, but we have connections that allow us to get into these kind of deals. They have a slightly different return metric, purely because they start out without any revenue, probably for about the first 9 to 12 months, depending on the renovation base that we have to start with. But we start leasing up probably usually around month 7, month 8. But in markets that are compressing the returns, this kind of a strategy is proving to be a winning strategy in terms of increased returns that the investors are looking for.
And a little background as to why we picked a hotel. I think since hotels did so poorly in 2020, they came at a pretty price this year. So the cost to renovate a hotel, which has very similar amenities to a multifamily, it has pool, it has a gym, it has communal areas and amenities where tenants or guests can share spaces. So it looked like a promising project, and the price was attractive to us, even with the cost of renovation. So that's kind of our angle as to why we picked up this property. So we're excited about it.
Yeah, and hotel owners right now, they're in a much different position than multifamily owners. Multifamily owners can ask for a premium for selling their assets, and that's why it's so difficult to find a good deal. So you have to think outside of the box a little bit, because these hotel owners have just gone through 2 years of, being in the red in terms of revenue for their hotels. So they're not in a position where they can ask for a premium. In fact, most of these are at a pretty deep discount. So that's what makes it attractive. And then, if we find the right team in the right situation, we can turn that into a multifamily pretty quickly. There's been a number of success stories with these, both in Phoenix and Tucson. So we expect there to be kind of a window of opportunity for the next year or two.
And then just a couple of different types of asset classes that we target as a fund. We primarily have focused on multifamily the last 2 years, but we still are interested in other asset classes that produce different types of rental income. Self-storage is really attractive to us. The hotel conversion that we just mentioned is something that we still plan on evaluating as maybe a couple more acquisitions under our belt, depending on what we find. And then also corporate rentals and Airbnbs. We are still looking at those. The returns are just very attractive for Airbnb and corporate rental. So I think that pretty much wraps it up. I have not taken a chance to look at our Q&A, but I'd love to hear from you guys. I'd love to hear your questions. And I will pull out the poll in case you guys still want to answer questions.
And any comments or questions, I'm standing by for you. So who's going to dive in first?
One thing to mention real quick, if you go back to the previous slide, so we put a link in here. So as we come up with opportunities, we'll post them on our website, and then really our goal would be to schedule a personal call with anyone who's interested in kind of exploring those, just so we can find out more about you, kind of your goals, what you're looking for, and if we have anything that may be a good fit. So kind of that's what we're doing there.
So Molly's asking that with all the building going on in Arizona, is there a water allocation concern in the future with the Colorado River supply?
That's a really good question. There's actually not. And the reason why is because a lot of land in Arizona was used for agriculture, and agriculture takes up a huge chunk of our water supply here. It eats actually like 80% of it. So if we repurpose the land for development, we actually save water. It's a good question. Also, another thing here is in the state of Arizona, when you develop new property, you were to create a lot and subdivide it, you have to go to the city and prove to the city that you have 100 years of water for your tenants in that development. You cannot build unless you can prove it.
Well, so Joe's asking whether we can share some of the numbers, income versus expenses, and the cost of renovation on the motel. You want to go back to that slide there, Sabrina?
Hold on a second.
So Kyle and I are pretty familiar with this deal, obviously. So the purchase price of 1.755. Total renovations are approximately 1.6. The biggest cost on this one was the fire suppression system that needed to be installed throughout the whole property. What we're finding with these kind of deals is that there may be rezoning requirements that can either kill the deal or certainly slow it down. On this particular one, there wasn't one. It was zoned appropriately, so that saved us money as well as saving us time. We're looking at approximately 15,500 per unit is going to be the overall cost for the internals, and then the additional is for the external, rehab and landscaping and painting and that sort of things.
Yeah, and these are obviously just projections. We just closed about a week or so, but kind of based on our initial underwriting, and we'd be happy to set up a separate call too to kind of walk through what that underwriting looks like on a year-to-year basis. We basically create a multi-year pro forma looking at what we expect the property to do, what we expect rents to do, comps, talking with the property manager to try to get their projection of expenses on a year-to-year basis, and then what that final NOI, net operating income, looks like for the project, and then how that translates to returns for the investors in the deal, which you can see for this one, we're projecting about a 17-18% IRR, internal rate of return. That essentially means over the life of the project, what type of return would you receive for your investment? And in this case, we have a couple cash out events, which basically returns a good chunk of that principal back to the investor, so they can go turn around and redeploy that somewhere else. So pretty interesting deal. And yeah, we'd love to talk in more detail if anyone wants to set up a call with us.
Yeah. Another question is Caleb's asking whether are we focused on any of the East Valley markets for Airbnbs and corporate rentals? If so, why those markets?
East Valley markets. When I think of East Valley markets, I think of Gilbert and Chandler, Mesa. I think those markets are excellent for corporate rentals just because you have PayPal, you have Northrop there, you have Intel, you actually have there's a small Google campus there. I think it'd be great for helping families relocate. You could do 3-month rentals, 6-month rentals. I think it's great. For vacation rentals, just to come and visit. I have a friend who owns there. He does pretty well. I just can't speak to it. But corporate rental income is very similar to Airbnb. It's just a matter of who your audience is. And because that area has a lot of good schools, a lot of good high schools, it's a huge single family relocation hub. It's just in my opinion, it'd be a home run for corporate rentals.
So Joe, the permitting process, it varies from property to property. This one was pretty easy, shall we say. Sierra Vista as an area, the city is very pro the expansion and the conversion models that are being offered, mainly because of the necessity for more accommodation. So when you've got those kind of metrics in play, the cities are a lot more accommodating to the processes of conversion and allowing therefore the permitting process to go a lot more smoothly with less red tape, as it were.
Yeah, based on some of our research in Phoenix and Tucson, we just looked at another possible opportunity in Tucson, but in talking to the city and some other zoning consultants, we're probably looking at 6 to 7 months just for the rezone, probably another couple months for permits, to bring it up to code and everything. So definitely depends on the city, and a lot of those city workers are very understaffed right now. They've got so much development and so many other projects on their plate, so it doesn't move as quickly. And with that opportunity, that was a big factor that we looked at, and as Charlie mentioned, that can sometimes kill a deal if the zoning isn't already kind of set up in our favor.
Just to add to that, because of the shorting of housing here in Arizona, in every aspect, single family, there's a shortage, multifamily, there's a shortage. The city has been open to conversions like this, especially since hotels can be more problematic than multifamily. You have a lot of people coming in and out. So multifamily is more stable, and it brings an overall economy boost to the location that it's at. The other hotel that we looked at, it was on a main city, like a main street within the city. So we weren't sure what the city had planned for future development. If they wanted to build a sports park there, having a multifamily on that street wouldn't have worked. So it really has to be in alignment with what the city has planned in terms of future development, what the goal, some of the goals that they have for the future. So it's a little bit more complicated than just your piece of land and your plans for your for that property. It has to go through due diligence and a number of processes.
So how do we calculate the ROI on rentals, and what kind of expenses do you see year over year, like unforeseen maintenance and vacancies, etc.? Who wants to take that one?
I think for multifamily, typically we budget around a 50% expense ratio, which in other words is your revenue over your expenses. That's kind of a rule of thumb. Obviously, the goal is to reduce those through things like looking for cost reduction strategies, water savings programs, energy efficiencies, management efficiencies, trying to find a good local manager who can help you, cut costs in other ways too. So that's kind of the general rule of thumb on multifamily.
And through the underwriting process as well, there are lender requirements, such as having reserves as well that need to be put aside. And that serves as part of the loan process and requirements for qualification to agree to do that. You don't have that in single families. And I think the way you look at single family maintenance issues and accounting for expenses is very different. It doesn't have the same metrics that we have to work on with multifamily.
Just the way that appreciation happens between multifamily and single family and how those two types of properties are appraised are wildly different. If a market downturns, the single family market is very emotional. So like whatever your neighbor sells their house for is probably what you'll be able to sell your house for. With multifamily, it's very different. It's based on a number of different values and metrics that we could probably talk about offline. But it's the same way on how you would, it's the same way in the sense that it's different on how you project rent growth and other vacancies and unforeseen expectations.
Yeah, and financing is obviously a big cost as well. as rates fluctuate, we have a number of different lenders that we work with to try to get us competitive pricing on the financing and flexibility in terms of terms, interest-only periods. Obviously, the rate is one of the biggest ones. There's a lot of different factors that goes into the financing as well, which can play a huge part in the success of a project.
Yeah. So Subhash is asking about the rent growth projections for Phoenix and the surrounding cities in the next 2 to 3 years.
In terms of what we think it would grow into?
No, I think more. I think we kind of covered it in as far as what the expected rent growth projections are. Usually in multifamily, there's kind of a rule of thumb that you allow or expect a 2 to 3% growth per year. But I think as Sabrina had showed earlier, the actual growth that Phoenix has seen over the last 4 to 5 years has far exceeded that. And I think with everything coming into the marketplace, along with the need and necessity for additional housing, that rent growth projection can only either remain or probably just get better. So it's one of the very few markets right now that 2 to 3% is kind of below what's actually happening. And we can't see that changing for at least the next 2 to 4 years.
Yeah. The other thing that might affect it is just, we talk about supply and demand. So there's lots of developers building new projects. They can only move at a certain rate. So right now they're not able to keep up with the demand, which is why we've seen such high rental increases. But it's something we look at in a certain area. We do see a lot of new development in the pipeline that can get absorbed pretty quickly. Obviously, that can affect the rent growth as well. So that's another factor, is just what's being developed, how quickly that's coming up. We've seen other cities that can get overdeveloped, and obviously that has a huge impact on the rents as well. So something else that we keep an eye on.
So the main difference between the preferred return and projected IRRs, the preferred return is the cash flow return that you'll get. It is the preferred element of it means that you are guaranteed it. And if you don't get it in your first year, what you lack gets rolled over. The projected IRR, internal rate of return, is the overall return that you can expect for the life of the project. If it's a 3-year project or 5 years, it'll be the timeline is what governs the IRR. So if you can get in and out of a deal faster, your IRR goes up.
Yeah, and it kind of, again, on the preferred return, it's also based just on the viability of the project. So it's basically the first 8% will go to you. Now, of course, there's risk to everything. So if the project doesn't turn out as well, it is possible that if the project doesn't perform, you may not get that full 8%. So just something to keep in mind. And, this is something for every deal that we look at and explore with people. But yeah, as Charlie mentioned, that's something that kind of gets set aside for the investors. And, it's the first 8% return of any deal. And not every deal has a preferred return as well. It just kind of depends on the structure, the value add opportunity, the cash flow, and some other factors.
So a few other questions. Lucid Motors manufacturing plant, what are the job opportunities around Casa Grande? And are you planning for multifamily in Casa Grande?
That is a good question. There's a lot going on in Casa Grande. Off the top of my head, and Subhash, I could probably send you this offline, like a deep dive of Casa Grande, but there are some huge headquarters being brought there, and there are a ton of single family lots being developed. Right now in Casa Grande, there are only 10 multifamily communities, and Casa Grande is pretty big. And I believe those 10 communities are fairly old. I think only like 2 or 3 have been built in the 2000s. So it just builds a lot of opportunity for us investors to go and start new construction there and create opportunity in that area, because there's nothing. Casa Grande is very far from everything else, which is why it's the middle point between Tucson and Phoenix. If you wanted to drive an hour in the middle, it's about an hour in the middle from both sides. So that whole area needs to be developed. You need commercial there, you need a residential, you need multifamily, you need multiple different types of asset classes. It's just land out there, but a few companies have stated that they're putting their feet down there. They've already hired there, like Lucid Motors. I had 2 friends from San Francisco fly down to do some work here already, and they were looking for housing. So it's just, and the problem with it is because it's so centrally located, there's not great options in terms of hotels, and you're about an hour from Phoenix. So they just need to keep building there. And it's another thing of supply and demand. That's why, in my opinion, it's a good investment because of the job growth as well as the lack of housing.
So what's our forecast for the Phoenix market in the coming years with interest rates expected to rise? What would be realistic expectation for the new investor?
So I can answer that from the single family side. Single family right now, there's no inventory. I think this time 2 years ago, we had 19,000 homes in the MLS. And to this date, we have about 4,000. If it's just any indication of how crazy our supply and demand is going. In terms of how hot the market is and projections, the thing that makes it so attractive about Phoenix is the affordability. So until affordability becomes a problem, you're still going to have a ton of people coming here. I showed you guys that map that has that $245 million land acquisition for single family. Those homes will still be in the $200,000 to $300,000 range, which is extremely affordable if you're coming from coastal cities, which most of us who are relocating are coming from. So until affordability becomes a problem, I still think there is enough demand where I don't think prices will drop. They might plateau as we continue to develop and people start finding homes that they like and it's not as crazy. But I don't think we're there yet. I think we're about 2 to 3 years away from that. Mm-hmm. And then also I saw a question about, let's see.
Then real quick, I think on the multifamily side in Phoenix, I mean, we're still very bullish. We're looking hard for deals. Deals are obviously very hard to come by, so you have to find them off market through different broker investor relationships. So we're kind of trying to harvest those as much as we can. And we definitely hope to find something that would provide kind of similar returns and metrics to what we're showing here. But we're also thinking outside of the box for things like hotel conversions or we just recently talked to a developer who's using some modular techniques and technology to build faster and quicker. So building a brand new build is attractive too. So we're definitely you have to be a little bit more creative in markets like this that are so competitive.
Yeah. The multiple offer situations, Joe, I don't think that's any different between single family or multifamily right now. There's my wife's a real estate agent, and I'm sure in the Dallas market it's no different in Phoenix. There's 20 to 30 offers per property, and for the multifamily, it's very similar. Agents and brokers don't even price the properties anymore. They allow the market to price them because they know there's going to be multiple people out there buying and bidding on it. And that's one of the issues right now, is that the properties get bid up more than they're really properly worth. And in 2 to 5 years' time, 2 to 3, maybe 5, it'll be interesting to see where the multifamily market is on how their properties are able to perform against what they're actually purchasing them for right now.
Mm-hmm. One of the other things in multifamilies that sellers really look for, when you're talking about such large transactions, they want to know that the buyer can perform. So they're going to do, their due diligence on the buyer, look at their resume, how many units they have, their experience, and things like that. So that's something very important. And one of our strategies too is we have a number of other strategic partners that are operators that we can come in together on a deal, and together, you know, we bring that resume and experience that the sellers like. So just another strategy of partnership, which is, you know, once you get into real estate, it's really a necessity to have the right partners in place.
Yeah.
Is that the last question we had?
At the moment, yep. Anybody else got any other questions?
Right.
Well, I think we've been on an hour, which is fantastic.
Oh, we got one more. What a team. Thank you.
We've got Brandon. Hello, Brandon.
Sabrina, do you want to remind people how to set up a call, or kind of how to log into the site?
Oh yeah. So then I guess just a quick note before everyone drops off. We are always actively looking to invest in several markets. Arizona is probably our top right now, as well as Texas. So if you're interested in investing or learning more about our projects or what we've acquired so far, feel free to visit our site. We have it linked here at Saber Equity, and we're happy to get on a call, talk through some of your investment goals, and see, you know, if there's a match there. But we're super bullish about Phoenix, and we definitely plan on taking on a few projects this year.
Absolutely.
Okay. Thanks, everyone.
All right. Thank you.
Thank you. Great seeing you all.